Okay, so welcome to our episode 10 podcast. We are keeping up the effort, and here we are, September 21st. Hey, is today the fall solstice? Fall equinox today.
It's here tomorrow. I don't know. Maybe probably to the 21st, I guess. Yeah.
Yeah, the official last day of summer, first day of fall. So, hey, that's kind of cool.
Yeah.
Well, welcome to the podcast today. And as usual, we're just going to be getting up to some market updates and recapping a few things that we've seen happen this week. You had $1 million offer go out, actually 1.4 million, and it was 11 offers went in on this property. So we'll talk about that a little bit later. The Fed announcement was this week. The Federal Reserve Chairman made a big announcement on policy updates and where he sees the economy going, which we can talk about. And we've got another headline here, says another big September Fed breakout. So yeah, more news about the Federal Reserve and what they're up to and how that's going to impact mortgage rates. And with that being our preface, let's jump into it.
Yeah. I mean, I think the biggest thing right now is whatever the Fed says, the market responds to. And they came out and they didn't raise rates, which is what they kind of anticipated, but basically say that they'll do whatever's necessary, keep rates as long as they want. The belief is the economy is going to have to start hurting for them to do anything in our favor. We're going to see higher unemployment and before they identify that we're actually in a recession. And we're just hoping right now in the mortgage side of things that the 10-year, it shot up to 4.47, which is a new ceiling that we're concerned about. Want to stay under 4.50, otherwise we may see these rates, go even higher. And so far it's staying there. Mortgage backs are trading down, so that's a concern. The market is trying to hold its own, where it's out there, but we just like to see some positivity, and it's challenging right now.
Well, and so we can touch a little bit more on how Federal Reserve impacts mortgage rates, because they are changing something that's not directly tied to it, but it does indirectly impact our mortgage rates. But basically, to really take this down to a kind of a brief nutshell, mortgage rates, for them to get lower, you kind of have to see some signs of difficulty and weakness in an economy. So it's not necessarily good news when mortgage rates are low, unless you're the person actually buying a house and trying to get a mortgage rate.
Well, the thing that helps those rates go low is the Fed's action. Because the Fed sees weakness in the economy, then they turn a different direction and they start lowering these discount rates, which they keep raising for short-term money. And that has a positive impact on mortgage rates. The other thing they do that they used to do, like back in the pandemic, they were spending $80 billion a month buying mortgage-backed securities. That's why the rates were as low as they were. Now they're spending zero. In fact, they're selling off all their inventory they had of those items. So the market is controlling right now where these rates are, which is why they're as high as they are. So if and when they get back in the game of buying mortgage-backed securities, we'll see an improvement. Nowhere near what the pandemic was, but we'll see an improvement from where the last 18 months have been, and especially this year. But the question is, how far out will that be? And that's what the Fed's kind of stretching out longer than a lot of people anticipated.
Well, and it's interesting because the Federal Reserve has tools to impact the economy on a significant level, but they're kind of waiting for the economy to tell them what to do based on data and forecasts that are coming in, right?
Yeah, and we always, or I do, my background's in economics, I always call it they overreact. They raise them for too long, and then they lower them, too late. And then the system markets have to catch up with themselves, and then they don't correct soon enough because they only have so many tools, and they never have the perfect, it's not the fourth down, goal to go, and they got the play to call. They're like a little, one day late and a dollar short, so to speak. But it's hard to control because they're moving factors they're playing with, and then you got the world economy. What's going on in Europe right now too has an impact, and China and Japan. So all these things are where the valuations are going on out there. So, but the bottom line is whatever the Fed does is what really impacts us directly, and they haven't been our buddy lately.
Well, it's interesting to watch these things and to try to have a clue on what's going on out there. And pretty much it's sit and watch from our perspective. We have to work with what interest rates are available and try to help get people qualified regardless of any market. But I do think in a high interest rate market, it is easier to buy a home if you qualify, because theoretically it would be less competitive in that market. Less people should qualify. And so you should be able to go make your offer and not be competing as heavily as when rates are 2%, everybody qualifies and everyone's out there trying to get a piece. But what we've seen lately at the 1.4 to 1.5 million price range here in Thurston County locally.
Well, that was King County.
Oh, King County. Okay.
Yeah.
Still pretty local to our area.
Yeah.
1.4 million. Well, you can tell the story here, but
you would think at 1.4, I mean, that's not your average sales price in King County. Nice property. And these clients have been looking at them for a long time. And when a nice property pops up, there's some interest. And so they were ready to go over list price, which they did. Thought they were pretty solid, and they were a very solid package. I don't need to go into any more details than that, but it's one where they list the property, and then they're going to accept offers, review offers on Wednesday, which they did. And then to find out that the 1.4 list price went for 1.57, $157,000 over the list with 11 offers at 1.4 million. It tells you that in the Northwest, there's still a limited number of properties that are desirable. I mean, there's a nice property, more than one person wants it. And that's the key thing. Have your property ready to go. If you do, it won't sit there. And that's why so many people are afraid of, I think we've gone over this, trying to find a house, but they got to sell a house. And that's where we've talked about that step-up product where we can, cure that issue for them so they can get in, have one move and make it happen versus the fear of not getting what you want. So those things are really important in this market because, I was shocked, honestly. I thought these clients had a really good offer because they were going up and over and they had a substantial down payment. The typical great scenario that a listing agent would love. And we can close it in less than 21 days, that kind of thing. And boom, $157,000 is $157,000. So a seller's like, are you kidding? Yeah. That was hard to take.
Kind of part of what we're seeing here, we're touching on what we just talked about with the competitive offer. Here's a headline from Mortgage News Daily talking about capital markets. Limited housing supply has been a problem for years. In 2019, before the onset of the pandemic, there was a shortage of approximately 4 million to 5 million housing units across the U.S. That was due to population growth and job growth outpacing new home construction and was exacerbated by historically low interest rates during the first year of COVID-19 real estate boom. The shortage intensified the last few years. Future home price changes will depend on supply entering the market. The hope is that home builders will ramp up production and empty commercial buildings will continue to be repurposed into residential units. Housing affordability is a problem in the U.S., so it's still tight out there. And this is a news line. I just printed this from this morning, from today, and kind of talking about what we just saw. It's you think it's going to get better, and it just still kind of remains tight out there.
It is, and it's not easy for builders to gear up and just crank out houses, especially in this county. It takes a while to get a subdivision approved, permits, you name it. You can spend over a year getting something going. And so all that stuff, and when they get geared up, is the market the same, the demand at that price range or what they're going to build? Those are some tough issues. The one thing about, there was another article you had printed out here, another big September Fed breakout. The verbiage they used in explaining this September breakout was almost identical to what they said in September of 22, which is ironic. So it means we haven't made any gain on the inflation issue. The market's still the way it is. We're seeing higher rates today than we were in September, but the Fed's position is still the same, which is kind of, you were hoping you'd see something, okay, we've hit this point, we're going to recover. No, and it's gone out a little bit longer, I think, than all the forecasters had predicted. So that's where we're dealing with some of these issues. So it boils down to, though, like you said, if you're qualified in this market, it's a great time to buy because I think in most cases, you can find what you're looking for. It's a great time to buy because more people get in when rates come down. There goes the price issue again. That they have all this idea when rates went up, prices would fall. That was way off. And so you can't just go on these forecasters. You got to go on what's really happening. And that's what we're seeing. And then witnessing that property in King County, I was kind of shocked.
I was too, because I thought, hey, you got a solid client. They're willing to go up. They have some leeway above what they even offered. didn't even matter. I'm sure there was an escalation clause on the winning offer that just said, hey, I'll go up to 1.5 or something like that, or 1.6.
He's probably going up 10 grand over anybody. I don't know. The interesting thing, because 3 other properties they were looking at over the past month were like 145, and they all dropped them, and then they sold. They dropped about 50 grand and sold. So I think this, and I'm not as savvy in the King County market as Thurston. So 1.4, this was a beautiful home. Maybe it should have been listed at 1.5. And so I got all those people interested in it for what they've been seeing out there. And so they jumped in and that pushed it up there. I don't know. That could have happened because it was, comparing to everything else out there, you didn't have to do anything to this house. It was, walk-in ready. And it was built in 1925, but revamped to the nth degree. So, but still, $1.4 million, or 1.57 in this case, is not everybody's wheelhouse. I mean, that's a
substantial piece of real estate, even in King County where prices are elevated.
Yeah.
Okay, picking up on the same article here, what about the near future? Lenders helped millions of homeowners with 30-year fixed rate lows in the 3s or lower, and few are in a rush to exit their current properties. At the same time, builders are concerned about constructing new houses that buyers may not be able to afford, which has pushed many of them to the sidelines. Student loan repayments are also about to restart, which is after, a 3-year pause, which can be another big setback for millennials who are looking to break into the market. A lack of homes for sale will keep prices high because it means buyers are competing for a limited supply. Turning to rates, this gets talks about the Fed. That gets a little confusing for me, and I feel like if I do this every day and talking about the Federal Reserve is confusing, then I'll probably just go broad strokes on that kind of stuff.
Yeah. Well, all you want to do is kind of focus what's pushed them today. Like yesterday mortgages had a negative reaction to the Fed's comments, and we kind of lost in the afternoon. Stabilizing this morning, and we're hoping it holds. If it does, that's a great sign that we might be here for a while versus looking at something with a little bit higher number.
Well, on this website here shows an average national interest rate, and I don't know, it's like a 20% down, so it's not really average in my opinion, but it's the average rate around the country for the best possible scenario. And I think they went from 7.39 to like 7.47 overnight, just an interest rate. So that's a pretty big jump if you ask me. And then we know that the fees associated with those interest rates may have gone up in addition behind it.
Yeah, I mean, it's up there. Mid sevens is where you're looking at those interest rates, and depending on credit and everything, it could be higher than that. And then some products have low rates, but you're going to see those fees, with it. And that's the biggest thing. Back in the pandemic, when the Fed was buying all the mortgage-backed securities, you could get a zero fee loan without a problem all over the place. The secondary market doesn't have that right now.
So if you were getting a mortgage, say it was your time to buy your second or third house or first house, whatever, is there any chance you'd be looking at an ARM in this type of environment where, hey, we thought rates were going to come down this year already. They haven't. How much confidence do you have in future predictions? Or are you like, hey, that 30-year fixed, at least you know what you're getting for the long term. And that's kind of more comfortable than a big what if, where when rates are dropping, you don't mind if your ARM resets to a lower rate. That might be nice, but you really don't know what you're going to get in this market.
Yeah, every lender, anybody on the lending side will be bullish on an ARM personally because they'll take the gamble because you never see the rates go up 5 years in a row or go down 5 years in a row. It's not static. It keeps moving. And so people will gamble in that industry that, hey, we'll recover and take that risk. Most people don't want that risk. Getting into a home is the level of achievement and risk in the first place. You want that stability. And so right now, and Fannie and Freddie haven't come back with aggressive arms in the market to make it really, let's go for it. Because when you had, say your fixed rate was 7.5%, if you had an arm at 6, go for it. And especially if it fixed it for 7 years. That would be great because then you're going to beat that average. And then if it does come down, refinance is always out there. If it doesn't and it moves up, then you got that concern of what's going to happen. And the arms come in 1 year, 3 year, 5 year, and 7 and 10 year variables. So if they're fixed for a long time, a lot more safety, but those rates haven't come to make that offset worth it at this point that we've seen out there. That could happen. But I think Fannie and Freddie have already painted the picture of where they want rates to be too.
And what kind of market that they're opening for primarily newer home buyers. They're kind of squishing the second, third home buyer, the vacation buyer, the investment property buyer, those are getting harder and harder terms on them. Not necessarily harder to qualify, but you have to have more reserves, bigger down payments, sometimes higher credit scores. So I guess they are harder to qualify in addition.
And the fees are higher.
And the fees are higher. So all that kind of makes it, like you said, paints a picture of it's open for first-time home buyers if they can afford.
First-time and primary residences are exactly what it's geared to. And it used to be second homes were awesome, but then Fannie came out and said, hey, a lot of these people are doing VRBOs, renting them out. They figure this stuff out. So then they price them just like an investment property. Right. So because that's what they feel they actually are. Because nobody, they believe, buys a property and only uses themselves for the entire year when they're living somewhere else. And most people live somewhere 6 months maybe, and 6 months here in Washington, maybe Arizona, some other warm climate, Palm Springs. Those kinds of things. But, so therefore that's kind of pushed that number out there. My philosophy always was it's only a second home initially. They should give them a break on that. Just like a primary, they should give you a break on that. Then if you make it rented out, then when you do your taxes, it's no longer a second home. It's an investment property.
Yeah, once you start claiming the income for it, then change the status of it.
Exactly. But Fannie doesn't listen to what I have to say. So its bottom line is what would be fair, because a lot of people have done it that way and they live far enough away from the properties and it's all legitimate. But they felt that it was being abused, so they changed it, made it more expensive, and therefore, if somebody wants one, that's what it's going to be. The thing was, it was almost identical for the cost of an investment property, but then you get to use the potential rental income for qualifications. It makes more sense. It makes more sense for the client, easier to deal with. Anyhow, those are not as attractive as they used to be. Yeah.
So what are you excited for in this market? Because it sounds like it's tough. And I don't want this update to be too much of a doom and gloom or like, oh, hey, it's still hard out there. I mean, that's a reality check, and that is a dose of what's going on in our current market. But I do still think that all the positives of home ownership are still there. So if you can get in, then it's still exciting, and it's still really fun to help people get in there.
Absolutely. Because owning a home, they use the phrase, the American dream. It really is, because it's one thing you can do here, and for your family as you grow, all these things. I mean, I don't think anybody's owned a home would say, darn it, I wish I would not have done that.
Well, there's probably some people that bought their house in 2007 that might feel that way.
Yeah, okay, if the market turned on it. But I mean, in a normal scheme of things, and if you can afford it in this market, then you're in a great opportunity, because I agree, they're not going to get cheaper. I mean, unless something major happens, and it's the competition is the rates come down. It's going to get more challenging. This is when you got to utilize the tools. I think, like we've gone over that, to help sell your existing home or get fastest cash to compete with cash buyers. Whatever you have to do, find out from your lender, because you can't just go in there straight up.
Well, and my huge thing is like, get all the way pre-approved. Have that loan officer send your file to an underwriter, get an underwritten approval, then go make your offer. And if your loan officer says, yeah, you're good, like just make sure, hey, did you send this to an underwriter? I want this to actually go and be seen by an underwriter. Thank you for helping me. You're doing a great job, but you're not they really need an approval on that. So that way they're really ready to go and there's no surprises coming up. Then if you're Security Plus, fastest cash, step up program, whatever specialty product you might need on top of that, cool. But don't make your offer, get it accepted, and then go say, oh yeah, I'm going to go find my financing because I've got 5 days to find a lender.
Yeah, no, bottom line is, in reality, give yourself a week to get it together. I mean, to get your stuff together, talk to your
business week. So
business week, yeah, a real week. Get the information in there. Give them a week to get everything submitted and underneath the eyes and pen of an underwriter and done. Then you're official. Now you're golden. But if you just hey, I'm going to make an offer. You call Friday, I'm going to make an offer tomorrow. Not exactly golden. We'll call the agent, tell them you're solid, but our underwriter, they're busy. They're not sitting there with nothing in front of them. I mean, they're working these transactions because everybody that is getting pre-approved, is what's happening. So when they can rock and roll.
And that's where, working with an experienced lender, you're not really going to know. But in our position, if I see someone that's really great, maybe I'll take a risk and say, hey, you are good. I know it for a fact. I'm going to send it to my underwriter. But if you wanted to make offers this weekend, in my experience, it's going to be okay. But I do that very seldomly, and only if the person is like triple qualified for what they're trying to do. and I'm familiar with the loan product they're doing and all these things. So sometimes, if you know what you're doing, you can say that, but the person's not going to know how experienced I am necessarily unless we have a long relationship to trust that or not. So,
well, there's so many questions that are unasked, which we don't know sometimes, off the cuff. Do you have a business on the side that you didn't tell us about? Do we need to check that out in your tax returns? Because you're a W-2 employee with 20% down, but what else is out there that might pop up that could change the circumstances? Where is your money coming from? Is it all squared away? Did anybody give you money, just got deposited last week, and there's a $30,000 deposit we have to document? These things are important, that take time. And sometimes the donor, the family member, isn't really thrilled on providing any more information. So make sure you get all that stuff squared away and know where it's coming from. There's easy ways to get through that you can avoid the pain if you let your lender know everything up front and be totally straight up and ready to roll. Because it can be painful if you just say, oh, don't worry about it, or you don't think it's important. Everything's important. It's our job to get you through there, and you think we work with the FBI by the time we're done, but it's because we know what to ask and to prepare so there's no 11th hour surprise.
Well, and I would say if we're getting everything underwritten in a week, that's actually pretty good and pretty quick. So give yourself at least a week. Maybe give yourself up to 3 months, because you might want to raise your credit score a little bit. You might want to pay some debt off. You might have a big deposit that you need that to sit in your account for 2 months before you can use it. So it might be beneficial to you to contact a lender when you're within 3 to 6 months and get yourself going and have that conversation as early as that. And then unfortunately for some people, then they don't find a house. And so we work with them for maybe 2 or 3 even years before they get just trying to make offers, which you hope it's quicker than that, for everybody. But sometimes that does happen. So I think being ahead of the game, it's not going to hurt you.
I know this. I've never had anybody that did it too soon. It's never, I should say always or never surprised me, both. That when they get, hey, we're going to buy something by January or December, and then next week they come in with an offer, and you're like, well, what happened?
Yeah, what happened to your time frame?
Yeah, well, we found this house. We just fell in love.
Yep.
And sometimes they don't know what they're looking for until they walk right into it. And then it's like, how do we make this happen? And sometimes they go and write the deal up before they even call us back and say that it's going on. So then you really have to scurry, and you really want to put their best foot forward and make it as smooth as possible. So that's where going through the process, which really is a simplified process, as long as you have everything lined up. If you don't, it could be, frustrating. And that's why dealing with some online lenders and stuff, you don't have that personal conversation, to sit down to walk through documents. Those things are important, I think.
I think so too.
And
that's what we're here to help guide through the whole thing and hopefully make it smooth, because you had a good consultant get you through the process.
Yeah, it makes a difference. It really does make a difference. And then having, Underwriters, I love Underwriters. We're based out of Bellevue, and they know the Northwest. Now, we lend in other states too. The thing is, they know the market and they know our products. And so it makes a difference when you're out there combating against those things, and what waterfront properties are like out here and how much waterfront there is, because they're different than some other company may say, we're doing an appraisal up in the Northwest, and they don't know our market. And some of the appraisers, you might have an appraiser from Everett appraising a property in Olympia with some of these online lenders, and you're kind of, just because they're available, or they're national appraisers. Different market, local. I've always lived that way, but it makes a difference, especially when you need it.
Yeah, and I can speak to that too, because I've worked for companies that are based locally in Washington, ones that are based in different states. And if you're based at least both on the West Coast, it's cool. When you have one part of your company in the West and one on the East Coast, and you have to deal with that time frame, that can be pretty difficult too, because basically one business day in most cases becomes 2 business days. Because if I get it to them in the afternoon, they're not getting it until tomorrow morning. So working local, especially if you're in the same state, it's really amazing.
Yeah, especially knowing the market, and with title and escrow, same thing. And the ability to, fund same day if necessary. Those things can be achieved if they know in advance. It's challenging if you have to do it at the last minute, and title companies don't like that. They'll do it, but typically probably cost somebody a little bit more money. But it's just doing as much as you can up front. And the thing that I've enjoyed here at Evergreen is they get things through so quickly. it makes the process seem better. So the sooner you start it, the easier it will be to get through it. And that's anywhere you're at. But I think, when you're dealing with something, you can walk in and they're accountable. I mean, you can go in, don't just hit us on the computer. You can come in and walk in our office. We'll be there.
Yeah, so just to give a touch on how volatile mortgage rates actually are, the Federal Reserve announcement came out yesterday. Our rates got worse. And then this morning, they were a little bit better than where they ended yesterday. So there really is day-to-day movement. Some companies will issue a rate in the morning and stick with it for most of the day. And some companies will have live pricing. So their pricing changes with the market. And whenever you lock it, you actually get the live pricing of the market. Whereas some companies are hedging their money basically and saying, hey, we'll buy the money for this, we'll sell it for that. Hopefully we played the market right. And
most of them are live pricing because they can't afford the risk these days, because the margins are so thin. Bottom line too is the market's trading worse today as far as mortgages go, but our pricing's better. So the market overreacted in the afternoon yesterday, and we saw it settle down a little bit, but still not trading better per se as far as Fannie's price goes and the 10-year. But our rates are holding their own today. So let's hope they do that, and we see a little bit of a stay under this cap, and that gives us a little safety net as we move forward. But if the advice today, if you're out shopping this weekend, I would lock in your loan if you're fortunate enough to get your offer accepted, I would lock it in. I wouldn't gamble on what's going to happen. If something happens, I think it's going to be hazy for a little while. And that'd be the advice that's out there. And in fact, yesterday morning, or right before my offer went in on this transaction, I was going to lock their loan. And
just to protect against any deterioration.
Because we have a lock and shop option too that people might want to start exercising these products, because it went up 0.5 point in fee. I mean, boom. And at that price range, it was substantial.
Yeah,
and
that's
so
a big impact.
It recovered a little bit today, but not the total amount. So it was, markets have a tendency when the Fed, and just like the Fed, they'll overreact. And then it'll take time to recover. They go up quicker, come down slower.
Yep.
So, and you always want to be protected from the increase.
So if you like watching the market, go ahead and watch it, but always call your mortgage guy to check what your rate actually did in response to the market, because you may be tracking that, and the market, they'll have some tendencies to track each other, but not always.
I'd say do your gambling on football and be safe on your mortgage rates.
I'd agree.
Yeah.
Cool. Okay. Well, we'll wrap this one up for today, and we will catch you next week for our next episode.
All right. Have a great one, and hello, fall.
Hello, fall. All right. Take care.
All right.